Have you ever wanted to invest in a company stock but weren't sure where to start? Choosing a stock blindly can be risky, and that's how many beginners lose money. Today, I'll walk you through the key things you must check before investing in any company so you can make smarter and safer decisions. We'll cover revenue, profitability, debt, dividends, industry position, valuation, management, and key red flags. By the end of this video, you'll have a solid framework to analyze stocks with confidence. Before we dive in, if you are new to the channel and not subscribed yet, subscribe now. You'll learn where to invest, how to grow your money, and how to avoid common investing mistakes. Let's get into it. Number 1. Revenue and growth trends. The first thing to check when analyzing a company is revenue and growth. Revenue tells you how much money the company makes from its core business. When evaluating a stock, always look at how revenue has grown over the past 3 to 5 years. Consistent growth usually signals a healthy and sustainable business. For example, if a company grows revenue by about 10% every year, that's a positive sign. But be careful of sudden spikes. Sharp increases in revenue can sometimes be caused by one-time events like asset sales, government contracts, or temporary demand. Revenue growth doesn't happen in isolation. A company's performance is strongly influenced by market and economic trends. When the economy is expanding, consumers spend more and companies tend to grow faster. During recessions, even well-run businesses can struggle. This is why you should compare the company's growth to industry growth. Ask yourself, is this company growing because the entire industry is growing or because it's outperforming competitors? Companies that consistently grow faster than their industry usually gain market share. Fast-growing industries also attract more capital, innovation, and long-term opportunities. Number 2, profitability and operational efficiency. Next, let's talk about profitability. Revenue alone is not enough. A company must be able to convert sales into actual profit. Key metrics to check include net profit margin, which shows how much profit the company keeps from its revenue, and return on equity, which tells you how efficiently management uses shareholders' money. For instance, a company with a 20% net profit margin keeps 20 kobo from every 1 naira earned. Higher margins often indicate stronger competitive advantages, pricing power, or cost control. But profitability isn't just about how much money a company makes, it's about how efficiently it operates. Two companies can earn the same revenue, but the one with better cost management will generate more profit. Metrics like operating margin show how efficiently a company controls expenses, while asset turnover shows how well it uses assets to generate revenue. A major warning sign is when revenue is rising but profits remain flat or decline. That usually means costs are growing too fast. Number 3, debt and financial health. Now, let's look at debt. Debt is like fire. When used wisely, it can help a business grow. When mismanaged, it can destroy the company. This is why financial health is critical when investing. One key metric to check is the debt-to-equity ratio, which compares borrowed money to shareholders' equity. Low to moderate debt is generally safer, especially during uncertain economic conditions. Debt also increases risk. In good economic times, debt can boost growth, but in bad times, high debt can force companies into bankruptcy. This is why understanding risk management is essential. You should also check the interest coverage ratio, which shows whether a company earns enough operating profit to comfortably pay its interest expenses. A low ratio is a serious red flag. Keep in mind that different industries tolerate different debt levels. For example, utility companies often carry more debt safely than technology startups. Number 5, dividends and long-term wealth. Dividends are especially important for long-term investors seeking passive income. A consistent dividend payout shows that a company generates strong cash flow and is confident about its future. Two important metrics to check are dividend yield and payout ratio. The payout ratio shows what percentage of profits is paid out as dividends. Be cautious of unusually high dividend yields. Extremely high yields are often unsustainable and may signal financial trouble. What makes dividends truly powerful is compounding. When dividends are reinvested, they buy more shares. Those shares then generate more dividends, creating a snowball effect over time. Even if stock prices grow slowly, reinvested dividends can significantly increase long-term wealth. Consistent dividends usually indicate strong and stable cash flow. Number 5, industry position and competitive advantage. No company exists in isolation. You must analyze its industry position, including market share, competitors, and unique advantages. Companies with strong brand recognition, patented technology, or loyal customers have a better chance of surviving economic downturns. This is where economic moats come in. An economic moat is anything that makes it difficult for competitors to steal market share. Examples include strong brands, patents or proprietary technology, network effects, and high switching costs. Also analyze the industry cycle. Is the industry growing or declining? Even a great company will struggle if it operates in a shrinking industry. Number 6, valuation and market sentiment. Even the best company can be a bad investment if the price is too high. This is why valuation matters. Metrics like the PE ratio and PB ratio help determine whether a stock is fairly priced compared to earnings or assets. Always compare valuation metrics to industry averages. A lower PE may signal undervaluation, but always investigate why. Sometimes stocks are cheap for a reason. Stock prices don't move on numbers alone. Market sentiment and psychology play a major role. Fear, hype, and emotions can push stock prices far above or below their true value. Overhyped stocks are often overpriced, while fear can create undervalued opportunities. Smart investors always separate price from value. Number 7, management and governance. Behind every successful company is strong leadership. Good management makes smart decisions about growth, capital allocation, and shareholder returns. Look for experienced leadership with a proven track record. Also, evaluate corporate governance. Transparent reporting, ethical behavior, and accountability are critical. Poor governance often leads to scandals, regulatory issues, and sudden stock price collapses. Insider ownership can also be a positive sign as it aligns management interests with shareholders. Number 8, red flags and final checks. Before investing, always perform final due diligence. Watch out for red flags such as consistently declining revenue, rising debt without growth, frequent management changes, legal or regulatory issues, or heavy dependence on one customer. Investing isn't just about making money, it's about protecting your capital. Avoiding bad investments is just as important as finding good ones. Conclusion: investing in stocks is not about luck, it's about research and smart decision-making. Before buying any stock, always check revenue growth, profitability, debt levels, dividends, industry position, valuation, management quality, and red flags. Study the numbers, understand the business, and invest with confidence. If this video helped you, hit the like button, subscribe for more investing content, and remember, your money should work for you, not the other way around.